Hello everyone. Today, we're diving into a fundamental concept in personal finance: how compound interest works. It's often called the eighth wonder of the world, a powerful force that can significantly accelerate your wealth-building journey. Imagine your money making more money effortlessly. That's the magic of compounding. So, what exactly is compound interest? Simply put, it's interest earned not only on your initial principal but also on the accumulated interest from previous periods. Think of it like a snowball rolling down a hill. As it rolls, it collects more snow, growing larger and larger with each turn. This is different from simple interest, where you only earn interest on your original principal amount. Compound interest truly puts your money to work. To understand it better, let's look at the compound interest formula. A equals P times 1 plus R over N, all raised to the power of N times T. Here, A represents the future value of your investment or loan, including all the interest earned. P is your principal investment amount, the initial sum you deposit or borrow. R stands for the annual interest rate, expressed as a decimal. This is how much your money grows each year. N is the number of times interest is compounded per year. This could be annually, semi-annually, quarterly, or even monthly. And finally, T is the number of years your money is invested or borrowed for. Time is a critical factor here. Let's consider a simple example. If you invest $1,000 at 5% annual interest, compounded annually, after 1 year you have $1,050. But in the second year, you earn interest on that $1,050, not just the original $1,000. This is where the magic begins. The power of time is arguably the most crucial factor in compound interest. The longer your money compounds, the more significant the growth. Consider two investors. One starts early with less money, say $100 a month at age 25. The other starts later, at age 35, but invests more, $200 a month. Assuming the same interest rate, the early starter, despite investing less overall, will likely end up with significantly more due to the extended compounding period. This highlights the immense advantage of starting early. Every year counts when it comes to compounding. A useful rule of thumb is the rule of 72. Divide 72 by your annual interest rate to estimate how many years it will take for your investment to double. For example, at an 8% interest rate, your money would roughly double in 9 years. It's a quick way to gauge growth potential. The frequency of compounding also plays a significant role. More frequent compounding, like monthly versus annually, leads to faster growth. This is because your interest starts earning interest sooner, creating a more rapid snowball effect. Let's compare with $1,000 at 5% for 1 year. Annual compounding gives you $1,050. Monthly compounding, however, would yield slightly more, around $1,051.16, while the difference might seem small over a short period. Over decades, this small advantage can add up to a substantial amount. Compound interest is at play in many real-world financial products. For instance, in savings accounts and certificates of deposit, your interest compounds. In investments like stocks, bonds, and mutual funds, reinvesting dividends and capital gains allows your returns to compound, accelerating growth. Retirement accounts like 401 kiloseconds and IRAs are prime examples where compound interest works wonders over decades, building substantial nest eggs. However, compound interest can also work against you. Credit cards and loans often use compounding, making debt grow rapidly if not managed. Now, let's talk about strategies to maximize compound interest. The single most important tip is to start early. Even small contributions made consistently over a long period will outperform larger, later investments. Secondly, invest consistently. Invest consistently. Regular contributions, even modest ones, add up significantly over time. Third, always reinvest your earnings. Don't withdraw the interest. Let it compound and generate even more returns. Fourth, choose higher interest rates where possible. Seek out accounts or investments that offer better returns to maximize your compounding. And finally, minimize fees. Fees eat into your returns, reducing the amount available to compound. Be mindful of them. In summary, compound interest is an incredibly powerful tool for financial growth. Remember, time is your greatest ally. Start early, invest consistently, and let your money work for you. These principles are key to building lasting wealth. Don't delay your financial future. Start your compounding journey today and watch your wealth grow.